Good morning. Thank you very much. So welcome to the third day of the conference. Very excited to be here. Thank you so much for including the paper to the program. So I'm Huang from WashU. This is a joint work with Jida from Notre Dame and Ronstein from CalTech. So in this paper, we want to touch upon a central question in finance. How do investors form expectations about future returns? So this can help us better understand investors' behavior and eventually market prices. So let's think about two scenarios. One is the housing market at the beginning of 2006, and the other is the stock market in October 2018. So at these 2 points, if you want to think about your expectation of future price change, do you think the price will go up or down? Chances are, in both of the scenarios, you will think the price will just go up. And this is like a party never ends. And why is that? Because this is human nature. As human, we would expect the best predictor of future behavior is, well, past behavior, and the trend is your friend. So this is so-called extrapolative expectation, and if you look at the literature, it's actually everywhere. We have direct evidence from the surveys, so the individuals, they display extrapolative expectation on aggregate stock market return, on inflations or housing prices or employment rate. We also have evidence from investors' actions. And not only extrapolative expectation is very prevalent, it's also intuitively appealing from theoretical perspective. So it shows promises to match asset pricing empirical facts, for example, the volatility and return predictability in the aggregate level, or the momentum reversal in the cross-section. But despite the intuitive appeal, when you look at empirical support, actually most of the models are tested with the aggregate level data. We don't have sufficient amount of empirical support in the cross-section, mostly due to lack of data, which can directly measure investors' beliefs on the individual stock level. And in general, we don't have a very good idea about the macro foundation of extrapolative expectation. So why do investors extrapolate? What captures extrapolation bias? And what factors affect the magnitude of extrapolation bias? Answers to these questions still unclear. So here is where our paper comes in. We want to ask these questions in the cross-section. So how do individuals form their beliefs about future returns in the cross-section, and how do such beliefs affect asset prices? So we're going to use a novel data set from a crowdsourcing platform called ForceRank. This is an app which collects expectations on future stock performances over a specified horizon. And all the results I'm going to show today will be based on 1 week horizon. So how does this work? So when you get on the platform, you will see there are multiple games. And each game lists 10 stocks, and what you need to do is every week T, you try to rank these 10 stocks based on your expectation about future returns over week T plus 1. And you can keep revising that until the end of week T. So during week T plus 1, that is evaluation week, and you just track your rankings against your peers and observe the actual performances. And after week T plus 1, everything is realized. You will get some points based on how accurate you are. And to incentivize the individuals, the platform gives shout-out on social media for the winners who accumulates most points within the past 13 weeks. And I do want to emphasize the winner is based on the cumulative points within the past 13 weeks, and this can alleviate some of the concerns about strategic behavior. Of course, it's very hard for individuals to be strategic and at the same time consistently accurate. I also want to mention some good features of this data. We do think it can stochastically dominate some of the alternative data sources. So for example, social media such as Seeking Alpha or Stock Trace They also collect individuals' opinions about future returns. However, they mostly only have the textual information, whereas force rank gives us precise quantitative information. Moreover, we also have a very clearly specified horizon, whereas when you go to social media, it's kind of hard to figure out what is the horizon that form the expectation. Another data source which has been explored in the past is analyst target price. So this data does have precise quantitative information and a precisely defined horizon. However, if you look at all the people who contribute there, they're homogeneous, and all of them are equity analysts. Not to mention there may be institutional bias, and it doesn't help if we really want to understand the belief formation of behavioral investors. I also want to point out two unique features of our data. So one is that the platform gives a fixed set of stocks to each individual. So this can avoid the complication of some selection bias. And also, we have a blind setting here, which means the users, they cannot observe other users' forecast while they are forecasting. So this can avoid the complication of herding behavior or strategic behavior. So now you must be wondering, how well do individuals form expectations? And this may not be a surprise to some of you. They are amazingly terrible, which means their forecast is not purely noise. They are not only wrong, they are accurately wrong in the sense that their beliefs negatively predict future return. So you can actually make money by doing exactly the opposite of their expectation. So why is that? And we're going to argue extrapolative expectation play an important role in explaining this return effect. And I will show some evidence.
To rank by your expectation. When you only get shot out if you win. Your incentive is to put high variance.
That's right. So that's why I emphasize the winner based on certain weeks. So if you want to do that. So this is a concern a lot of people talked about, and we thought a lot about that, and we can talk more later on. So to preview some of the results, I will first show individuals they extrapolate from past returns, and then we will look at some return predictability in the cross-section. And we think what we're trying to say is actually nicely captured by the slogan of force rank. And they really know what they're doing. So instead of uncovering the wisdom of crowd, what they're trying to do here is unlock actionable stock sentiment data. So now let me give you some example of other games on this platform and also talk some statistics. So there are two types of games. The first one is the sector game. So we have sectors such as social media, hardware, etc. And within social media, you will get a list of 10 stocks. So this is the first type of game. And the second type of game is so-called catalyst game. So we will have 10 stocks, which is mostly heavily shorted in a month, or they have the earnings announcement coming up. And our sample period covers from February 2016 to December 2017. And the same game is repeatedly conducted every week. And we call each weekly game as a contest. So we have about 1,400 contests on the platform, which covers about 300 tickers. And most of the firm, they are very large and growth firm, and they have their names individual investors are very familiar with. And to give you some idea, each contest has about 20 entries from the users. So for most of the empirical analysis I'm going to show you, we will take a consensus across these 20 individuals. And for the users, a third of them are from professionals and 2/3 are from non-professionals. So we will first start looking at how investors' expectations relate to past returns. So we regress this consensus force rank score on past returns. And so just plotting the coefficients in this graph, x-axis is for the time lag. So from your left to right, that is from most recent to the further past. And we are making two observations here. One is individuals, they extrapolate from past returns because most of the coefficients, they're positive and significant. And second, there is a decaying pattern. So they put higher weights on more recent returns. And these two features actually remain pretty robust even we adding controls for fundamental news or media coverage or cap and predicted returns. And now going forward to capture these two important features, what we want to do is to impose, I think I get the same problem as what Sam gets, and this is even harder to, I think, to read now. So basically, you need to imagine we're imposing an exponential decay model on their expectations. So there will be a weighted average of past returns, and all the weights sum up to 1. And in front of that weighted average, we will have the first parameter, which is lambda 1, and this captures the level effect. And this is a scaling factor that captures the overall extent to which individuals respond to past returns. And if we move on to the weighted average part, so the weights we will have our structure, which is an exponential decaying structure. Basically, the parameter lambda 2 captures the rate, decaying rate. So a lower lambda 2 means a higher weights on more recent past return. So basically, a higher lambda 1 and a lower lambda 2 indicates a higher degree of extrapolation bias. So the higher lambda 1 here, meaning they put a higher overall weight on the past returns, and the lower lambda 2, meaning the decay rate is faster. So estimating this exponential decay model, the lambda 2 is around 0.55. So this means the returns 4 weeks earlier are only 9% as important as returns in the past week. So you may still argue with me, maybe this is just some simple statistical relationship between force rank score and past returns. So how can we know this is how investors form expectations? So one thing we did is last spring, we did a survey with CalTech students. And it's very surprising, but at the same time also reassuring. Among this group of people, you would think they probably sit on the more rational side on the spectrum. Actually, based on past returns, come out as the #1 popular reason. And you can also see there are huge heterogeneity across how they form expectations on past returns. So we do think one important value of our data is try to use it to understand the micro foundation of extrapolative belief. Without getting into the details, I want to give you a summary of some of the empirical facts we collected about micro foundation. So we looked at asymmetric effects between positive past return and negative past return. So what we find is the investors, they put higher overall weight on the negative past returns, and they also have a longer memory span. So this is consistent with the notion that disasters last longer in investors' memory, and it's also documented in some of other papers. We're also interested in the heterogeneous effects across professionals and non-professionals. And we do find the professionals, they behave in a slightly more sophisticated way, meaning they rely less on past returns and have a longer memory span. And then we also look at how firm characteristics affect extrapolation bias. And through looking at the firm characteristics, we realize maybe salience actually plays a very important role affecting the extrapolation bias. So then we did a test more directly measure the salience of the returns. So we use news coverage to characterize the returns into salient returns and non-salient returns. And we find, indeed, investors, they put higher overall weight and have a longer memory span on the salient returns. So we do believe better understanding of the micro foundation can help us eventually better understand the market prices. But first, we need to try to link the extrapolative expectation to asset prices. So what I'm going to do next is I will just illustrate the basic idea behind this extrapolation model. And then we will also go through some main predictions we're going to test in the data. And then we will look at the empirical results. So we have a very standard extrapolation model. Here we have a finite horizon, and we have multiple assets. And each asset is, so this is a claim. This is a single claim to the dividend at the final date, capital T. And this single claim is equal to initial dividend plus a sequence of IID normal shocks. And we have two types of traders. And the first type is a fundamental trader. So fundamental traders' expectation closely tied to fundamental value. And they make up mu f of the economy. And extrapolators makes up the rest of the economy. And here is the key behavioral assumption. So basically, the expected price change has exactly the same exponential decay specification we used in the empirical analysis. And their share demand for the fundamental traders, their share demand will be related to the fundamental value, and extrapolators' share demand will relate it to the weighted average of past price changes just by construction. And given each asset has a fixed supply, market clearing conditions determine the equilibrium prices. I think this slide is very confusing, but let me just talk about the intuition. So here are some key predictions we're going to test. The first one is if we regress future price change on the past weighted average of past changes, the coefficient B will be negative. And the intuition is like this. Suppose there is a positive shock in time t, so that will push up the price. And because the extrapolators think the price will keep going up in the future, so that will further push up the price, leading to overpricing. And this price will come down the next period because fundamental traders think the price will go back to fundamental value. Whereas the extrapolators, now they feel less excited about the previous shock because the decaying structure, and the equilibrium price will become lower. So this negative price change and the previous positive shock gives the negative relationship between their sentiment and their future price changes. And this return predictability will become stronger when there are more extrapolators in the market, and also when the extrapolation bias becomes higher. So now let's take this to the data. So the first thing we did is to regress the future return on force rank score. And as I just mentioned, so the force rank score negatively predict future return. And we argue extrapolative expectation plays a very important role in explaining this. So to test that hypothesis, we want to construct an extrapolative component, which is the predicted score. So this is the weighted average of the past returns. And basically, this is the fitted value from the nonlinear specification estimated from force rank score. And consistent with the model prediction, what we find is the predicted score also negatively predict future return. And I will talk more about that. Our interpretation is force rank score represents the thinking process of behavioral investors in the market. And to evaluate this economic magnitude of this effect, so we run the trading strategy. So at the beginning of each week, T+1, we sort all the stocks based on their force rank score submitted within week T. And the return spread between the top quintile and bottom quintile is reported from columns 3 to 6, controlling for a different set of risk factors. So if we just focus on column 6, here is controlling for Fama-French 5-factor model plus momentum and short-term reversal. What we have is the abnormal return is around 7 basis points per day. And it's approximately 18% per year, which is a very sizable effect. And if we want to capture the exponential, extrapolative component part, if we sort all the stocks based on their predicted score, this return effect shrinked a little bit to 5.5 basis points per day, which is approximately 14% per year, which is still a very sizable effect. And if we sort the stocks on their past week return or past month return, as in the traditional short-term reversal strategy, actually the return effect becomes much smaller and insignificant here. That's mostly because our sample captures very large stocks, and we know the traditional short-term reversal actually becomes weaker for that set of stocks. So now we find, on average, the extrapolative components negatively predict future returns. So to further support the extrapolation model, we want to then look at how the return effect varies with some variables related to extrapolation. So we will look at 2 dimensions. The first dimension is the fraction of extrapolators. So how can we capture the fraction of extrapolators? So we will use the institutional ownership. So we will use institutional ownership to capture the fraction of fundamental traders in the market. That means the stocks with lower than median institutional ownership will have more extrapolators. So if we look at the results, column 1 relates to the stocks with more extrapolators, and column 2 links to the stocks with less extrapolators. And we can see most of the return effect coming from the group with more extrapolators. And this is consistent with the extrapolation model. The return predictability becomes stronger when there are more extrapolators in the market. And the next dimension we want to explore is the extrapolation, the magnitude of extrapolation bias. So basically, previously, we only estimate a set of parameters for the overall sample. So we don't allow any variation in the extrapolation bias. And now we will estimate this extrapolation parameters for each game. So for each game G, we will estimate a set of parameters number 1G and number 2G. And we can also do the same thing by estimating the parameters from realized returns. And effectively here, we're imposing rational expectation. So basically, we just replace the force rank score on the left-hand side by using the rational rankings based on realized return. Okay, so let's look at the prediction. So for the level effect, estimated from the realized return will be proportional to the slope coefficient we mentioned before. And we think this can capture the degree of mispricing. And if the level effect estimated from force rank is higher, that means the level effect estimated from the realized return will be more negative, which means the return predictability becomes stronger. So this is what we find in the data. Here, if you look at the x-axis, that is the level effect estimated from force rank score. So from left to the right, meaning investors have stronger extrapolation bias. And when that happens, the level effect estimated from realized return becomes more negative, which means the return effect becomes stronger. And we also have another prediction on the slope effect. So basically, the decay structure embedded in the realized return should be the same as the decay structure embedded in the extrapolative expectation. And the intuition is that because fundamental traders want to drag the price back to fundamental value, and the most effective way for them to achieve that is to use the same decay structure as the extrapolators. So this is also what we find in the data. If we look at the slope effect estimated from force rank score, that is the x-axis, and compare it with the slope effect estimated from the realized return, we can see they're positively correlated, and the slope is 1.06, which is insignificantly different from 1. So just to avoid the confusion, the t-statistics here is to compare with 0. So now we want to interpret this force rank score. And I do want to emphasize what we're not trying to say is that force rank users, they can move the market prices, or the force rank users, they represent all the market participants in the market who trade on these stocks. Of course, we only have a small group of people. By no means we can really achieve this too. But what we are trying to say is that people think alike. And some of us, we may deviate from the standard model in a systematic way. And force rank score is trying to capture the thinking process of this kind of behavioral investors. So here, specifically, we're trying to capture the thinking process of extrapolators in the market. And the other part is the fundamental traders. And the interaction between these two groups result in the observed return predictability we were talking about. And by better understanding how behavioral investors form beliefs, that can help us better understand the asset prices. So now we understand some belief structure of the behavioral investors in this force rank score. The next natural question is whether this is generalizable. So to test that, we're going to run an out-of-sample test. So we will extend this belief structure to stocks not covered on force rank, and also extend it to a longer period. So what we're doing here is we form a predicted score, which is a weighted average of past 12-week returns using parameters estimated from force rank. And we also have a predicted PN, that is a predicted score allowing asymmetric effect between the positive returns and negative returns. So what we find is, indeed, these two predicted score negatively predict future returns. And we think this is additional evidence saying that force rank can represent the thinking process of behavioral investors in the market. And to avoid the concern that this is leading or driven by the liquidity story, we also focus on the large cap stocks, and we find the two predicted score still negatively predict future returns. So this suggests that this is not a simple manifestation of liquidity shocks explains a return reversal, and maybe extrapolative expectation also plays a very important role in explaining the traditional the return short-term reversal. And as I mentioned, there is a huge heterogeneity in investors' extrapolative beliefs. So by no means we're trying to back out some magic number here, but we do think this is a very helpful way for us to better understand investors' belief structure from the survey data, and better understanding the microstructure also adds some value. So now to conclude, we find that investors, as in a lot of other contexts, they extrapolate from past returns when they form expectations on the individual stock level. And we also collect some empirical facts about the micro foundation. And then we find consistent with the extrapolation model, the extrapolative component of force rank score negatively predict future returns. And we find value to learn something from the survey data, and also that can help us better understand the asset prices. At the end, I want to leave you with one piece of evidence. So far, we only focus on the extrapolative component. If you pass out this component and look at the residual component, the residual component still has predictive power for the future return, and they also negatively predict future return. So we think this may suggest force rank score may capture additional sentiment not associated with return extrapolation. And we think that probably points towards some exciting opportunity for future research. All right, so I will stop here. Thank you so much, and I look forward to Burton's comments.